All right, so today we're continuing our discussion from last year. Stephen Beer is here. He's a CPA who we worked with on a lot of our buildings. And we began a conversation last year on budgeting. On the expense side, this year we're going to talk about on the revenue side. Talk about income streams, hidden assets, and mainly we're going to focus on reserve funds. And proper use of reserve funds, when you can borrow from a reserve. So why don't we start with Stephen, because he's got a lot to say and he's very interesting.
Thank you. Back when the conversions were going crazy in the 80s, when there was a rent-controlled or stabilized tenant in the building, they got an insider price for their apartment. And the concept of flip tax was created to say if you flip that unit, then the building should get something back for that you got a lower price. So the term started as flip taxes, but really what exists now is what's called a transfer fee in most cases. Where there's a flip tax, sometimes it's the amount of profit you had, it's a complicated calculation. A transfer fee is very standard these days. They range, but roughly 2% of purchase price is what I see in my buildings. It's a way to give back to the building for the capital work that needs to be done in the future. So if you remember what I was saying about setting aside that $15,000 a year for the roof when it needed to be done in 20 years, a person has lived in the apartment for a period and has been living off of the roof, the elevator, this. A transfer fee is a way to recoup some of that money. Prospective purchasers used to look for buildings that didn't have them. They're less likely now. Most everybody accepts the transfer fees. So it's a great source of revenue. And your choices with that are to use it for operations or to designate it for reserves. Using it for operations has two problems. One is if you budget for it and it doesn't come in, now you have a deficit. For some reason there were no sales. In 2009 was a good year that there were a lot of buildings that didn't have many sales. And the other is you get used to the money by using it for operations and you need to keep feeding yourself. So some buildings will use it for operations but not budget for it. That's sort of the middle ground. And if it comes in, it's available. If your income and expenses are in line, it's available to go into that operational surplus account that I mentioned, the rainy day fund, in case there's a problem someday. We've got some extra funds. And then it can be used for capital if it wants to, if you wanted to. But a lot of the buildings are looking for a long-term funding vehicle. So we talked about the 10% Fannie Mae requirement, and this is a way for a co-op to put aside money. And that's a long-term funding vehicle, that 10%. Transfer fees going into the reserve fund that are designated is a long-term funding vehicle. There are some sophisticated purchasers who are looking and saying, what is the funding vehicle? Is there something that it's not going to be that I'm going to be assessed someday because of work that needs to be done on the building? We touched upon the storage units in my example before, but with the cost of going to a storage place plus the inconvenience of having to have to go there to get your stuff every time you want something, it's very helpful and everybody prefers the luxury of having the storage units in the building. It's my understanding that it makes sense to do it, and it's usually, you have two choices. You can either have an outside company come in and set it up and then they give you a piece of the action, or you can build it yourself. Most of the storage units in the buildings that I'm aware of are basically sold out. There are waiting lists. So it's a great way, if there's extra space, if it hasn't been done, it's a great way to raise money. Bike rooms are another source of revenue. We see how much the city is doing to try to make the city better for using your bike, so that's a great thing for the future. Gyms you can charge a fee to use the gym. Fitness centers are nice amenities that a lot of people are looking for. They don't want to have to go out to a fitness center, so that's a good one extra. The garages in the buildings tend to be rented to outside operators. It's really hard to run a garage if you're trying to do it yourself, so it generally makes sense to have the outside operator do it. They pay rent, and you can get some really good competition if you have bidding when your leases are up. So it's a great source of money. I do have some buildings where the unit owners just use the spaces, but that's very rare. A lot of times people who live in the building will get a discount from the garage operator as part of the package. It's just a nice way to make it more comfortable for the people, and the garage operator gets a steady source. So it's good to work that out in the negotiations. So creating fees are a good way. I talked about what I call nickel and diming, and so some of those fees that are out there these days are move in and move out fees, sublet fees. So these are items which are charged to unit owners just when they do something, or tenants. What I normally suggest is that we ask a list from the property manager like Argo about the types of fees that are being charged in other buildings, and to see whether or not there are some that we should put in. Take a look at the amounts and see whether or not you're comparable to other buildings, because we tend to see these sort of just get left and they don't get increased, and they could be a good source of revenue on and on. The laundry rooms, it's another pain to keep track of all those coins, so a lot of times there's an outside operator, but I have to tell you, the ones that do collect the coins seem to make a lot more money. So I don't know whether if you have a contract, when it comes up, whether you want to consider it. You do have the costs of repairing and maintaining it. If you're comfortable with your super, it's another source of good money. So it tends to be that there's a pretty good profit there. The cell phone bonanza maybe 20 years ago created a lot of need for antennas on the roofs of the buildings. It's a great source of revenue for a very small area of your roof being used up. It can give you some big money. Nowadays, it seems to be that most of the carriers have what they need, and they tend to come to you if they need your specific place to fill in their grid, but it's another option for additional funds. The cable into the building, it's an expensive proposition to wire it, but if when FiOS and Time Warner are really interested in it, they'll potentially give you an upfront payment to come into the building, or they'll share the revenue with you. So these are great sources of additional funds that come along. Under here, I just put a little cost savings. I know Mark said, we did cost the last time, but I just wanted to touch upon these. Cogeneration is a great way to end up creating some really good revenue. Cogeneration is where the building's hot water comes from the boiler that's run all year long, the heating boiler. If we can find another way to create the hot water, and we can have sub-meters in the building that we can charge the unit owners for their use of electricity, we can potentially consider running a generator which would create electricity. We sell it at a profit to the unit owners, and the extra heat that's created through that process heats the hot water. So if there's room to put it in, it's generally on buildings of 300 units or more. It's a great concept. And lastly, I always like to put in about it's cheaper to pay the men in the building to do work if they're capable for it than bring somebody in from the outside. So I've seen buildings find some big cost savings when they change supers and they put the strategy of giving super a payment as opposed to having other people come in, sending the super to a training course on the boiler, things like that. So just food for thought.